Hi, and welcome back to the Digital Dividend from Fasanara, the podcast where we shine a spotlight on one of the lenders on our digital lending platform and try to dive into some of the lessons learned from the founders and CEOs running these lending businesses. Today, I'm joined by my colleague from the origination team, Shreya Sumar.
Hi.
And we have as our guest Gabriel Thierry from Karmen.
Hi, Matt.
Hey, and so as we've talked about in prior episodes, the whole idea of this podcast is really to give insights to people within the lending industry, to give people a little bit more of an opportunity to see different lending models and get accommodated with them, as well as people who are just interested in general in lending and investment opportunities. So, at that, I'd like to give you the opportunity, Gabriel, to kind of introduce yourself, Karmen as a lender, and learn more about what type of lending you do, in which markets, and to what types of borrowers.
Yeah, thank you, Matt. Thank you for inviting us and shedding the light on what we're doing at Karmen. Hi, everyone. I'm Gabriel in French, and I'm one of the three co-founders and the CEO of Karmen. Karmen is a specialty finance, revenue-based financing platform based out of Paris in France. And we mostly underwrite digital SMEs, such as software businesses and e-commerce businesses, on their working capital problematics and limitations. So we'll come and basically the way it works is we'll connect by APIs to all their systems, export a bunch of API based and super granular data to start powering proprietary algorithms in order to power bank underwriting decisions. And the whole concept is based on the fact that, as you know, traditional lenders, namely banks, tend to stay away from these digital SMEs for various reasons. On the first hand, of course, they tend to be small SMEs, just as the name dictates, and so they're not very profitable for banks to underwrite. By definition, they're also digital, which means they have very light balance sheets, which of course banks don't like because there's no collateral to seize in case things go sour. And in general, they tend to be pretty volatile, pretty cyclical businesses, which traditional accounting and traditional financial statement analysis does not really give justice to. So we've kind of reinvented the wheel here at Karmen, and instead of using traditional financial statements and accounting data, we connect directly to the tools that companies, these SMEs, use on a daily basis to extract as much live data as we possibly can to start powering proprietary algorithms. So for example, we'll connect to their open banking tools with open banking data. We'll connect to get all their transactions. We'll connect to their billing data. We'll connect to their accounting tools. We'll connect to their CRM, their marketing tool. And just like that, basically through APIs, we get a lot of instant data, which gives us a very comprehensive overview on how the company's been doing recently, both on a financial basis, but also on an operational basis. And that's the underlying work at Karmen.
Okay, thanks, Gabriel. Can you talk to us a little bit about why did you decide to build this business, with whom, and how did you start out?
Yeah, the original idea, I think I have to compliment the Americans, right? They tend to be a bit more forward thinking than continental Europeans when it comes to dynamic and alternative credit. And funnily enough, revenue-based financing was something that I discovered in the US when I was working there in private equity and venture capital. And when I moved back to France during COVID, I saw that there was a huge widespread opportunity to export this model in France, where legacy banks tend to be even more archaic than what is going on in the US, and where there was a huge market ready for disruption. So I met my co-founder at HC, the French business school, and then we partnered up with Sébastien, the CTO of Karmen, and we decided to launch Karmen basically on the opportunity of replicating what we saw alternative lenders in the US doing well, but then adapting it to a very different market, which is the French market, which, as you know, is very regulated. We have the French banking monopoly, which is probably one of the toughest and most important French credit regulation in the world. And then, of course, adapting it to the French market, which has a lot of different intricacies when it comes to credit consumption, credit prices, and risk appetite. Um, I like to think that continental European countries tend to be a lot less risk friendly when it comes to credit than what the Anglo-Saxon countries can see, which means that, of course, in terms of yield, in terms of risk, you see very different dynamics. And so, of course, we have to adapt our operations to that paradigm.
That's super interesting then that you saw this idea, saw something new, a different lending model, and said, "Hey, how can I apply it within the market I knew that I grew up in?" I'm actually curious to know: has it been ever difficult, or has there ever been friction with your co-founders since you kind of met at a very early stage and have been basically creating your first kind of business together?
Yeah, it's the first business we create together, and I have to say we've been fortunate because it's gone really well from a relationship perspective. Of course, there's been some ups and downs, and as you know, the startup founder life can always be a bit rocky and bumpy, and there's some good days and some bad days. Especially when you see the core interest rate of reference markets go up 500 bips, that always puts a bit of pressure on new lending models that have to kind of show their worth. But I have to say our relationship's always been great, and they've been great partners with very complementary profiles, and I'm very lucky to have them on board.
That's super nice to hear. I mean, at the end of the day, I think a lot of people and kind of have this dream of being able to work with their friends, and it's cool that you're achieving it and finding a framework to keep essentially the relationship, functioning for everyone involved. I'm wondering, since you had that as kind of a groundwork, you had someone you could trust to bounce ideas off of and to build things out from the first start. What would you say might have been some of the challenges you faced early on when you were first kind of building out the concept, and then maybe even trying to get funding and get off the ground?
Yeah, it's a great question, and I think I'm gonna drop you a flower here on that one because we owe a lot to Fasanara for this because when you start launching a credit product and a new fintech in the lending space, the hardest thing first is access to capital, right? Because we had the early innings of our technology, which was very premature, but it was still there. We had some clients, of course, who were willing to engage into our product. But until you have money, when you're lending money, you have no product. And that's where, when we launched and we managed to speak to the Fasanara team, I think that the current instantly matched, and there was some great chemistry there, which is still going on, and it's great to hear. But you gave us our first dollars, if I may, when it comes to the lending activity, and that's what pumped the machine in the first place. And that's, I think, the was a great way for us to get to launch quickly and to make sure that we could satisfy our first client's needs. But that was the first big hurdle.
Well, that's great to hear. And again, we kind of pride ourselves on kind of not just taking a risk on new businesses, but trying to identify strong lending models that, at the end of the day, everything comes from the approach to risk. And anyone can give money back out, but getting it back is the tough part. What we saw with you and your co-founders and your model was a very direct way to kind of take unique approach to underwriting, leveraging these technological elements you spoke to before. So the API connectivity, giving you the open banking, the accounting data, CRM data. I mean, I think these are topics that have expanded in kind of use, but the fact that you were implementing them from day one and focusing on that was super attractive to us. For us, it's been a very positive journey as well together, seeing your book grow and seeing everything develop within the scope of, again, a prudent risk framework.
Gabriel, can you talk to us a little bit, maybe about sort of, what makes you different? What is your USP in the market?
Again, it all comes down to um, what the banks are leaving behind, right? If the banks didn't leave stuff behind, we would have no reason to exist because, of course, we'll never have such a competitive cost of capital and network as they have, right? But the reality is that, banks are huge institutions and they have a lot of regulation and restrictions that doesn't allow them to engage in all the activities they would like to or that they could do from a technology perspective. And that leaves a lot of crumbs on the table, for specialty lenders like us to really go after. And the reality here with digital SMEs is that for the reasons I explained earlier, they are completely underserved when it comes, at least in France, when it comes to their working capital problems, right? Which means that, for example, an e-commerce company, which is a fairly substantial part of our portfolio, when they have to finance a production run, for example, for an Asian supplier, and the Asian supplier asks for like a 50% or 70% down payment, which is the case currently, they need money to finance that production run. And if they can't finance that production run, they can't import and they can't manufacture their goods, which means that for the next season, they have no goods to sell. And so we saw a lot of limitations, for example, in these various digital models, whether it's e-commerce, whether it's software, whether it's mobile media, B2B services, which are our main lending activities at Karmen on the SME side. And that's where, short-term working capital loan serves as a great efficiency and capital liberator to help these businesses grow in a much more sustainable manner and not be limited by working capital constraints. And that's where the real kind of USP lies in Karmen, is being able to access capital quickly, reliably, at a great cost, because it is a competitive cost, even though of course it's more expensive than what a bank would offer. But you have these value propositions in terms of reliability, in terms of speed, and in terms of understanding, right, through data, through APIs, through a modern and innovative approach of what business risk actually looks like, to help us and to help these SMEs grow.
Okay. You mentioned a little bit on the French market and how it's, peculiar, different. Can you
Yeah.
talk to us a little bit about what you're seeing in the market right now? How is sort of lending, and within that alternative lending, how's the market looking like?
Yeah, there's a couple points there, right? Like the first thing is that it's a super attractive market in terms of size, right? It's the second largest European market, continental European market after Germany when it comes to, the categories that we serve. E-commerce is huge and growing. We have, of course, like a growing population with some pretty good macro and demographic indicators. So there's a huge opportunity to serve from a demand perspective. And then, of course, the traditional legacy of strong regulation and oligopolistic banking behavior gives us a huge opportunity to operate, right? Because as I said earlier, we operate in this market where there's a very strict regulation with the banking monopoly. France is, to my knowledge, one of the few, if not the only European country that has such strict banking monopoly regulation. And that makes it really hard to launch a credit activity, right? So we've had to invest a lot of money and build really complex infrastructures to be able to do this, which first, of course, is a way for us to build credibility in the market and build credibility for our clients who can trust us. But also, it's a great source of barriers to entry for us as lenders, because we don't have much international competition from foreign players who would lend in France, because they don't have the right authorizations or the right uh, regulatory framework to do so. And that's great for us, because that means we're not, operating in that much of a competitive market, which is keeping the true cost of risk at its right price, and is great for us lender, because we can actually price the risk and the price of our loans with respect to the risk, and not as opposed to competitive pressures like in other geographies.
And Gabriel, we've talked about banking monopoly. You've talked about kind of the hurdles it poses, but just for our listeners, kind of wondering what this term means, and why is it posing a barrier to entry? Could you maybe provide a bit more detail on what it is, and also why then it has resulted in you need to spending what we know very well is a lot of time and effort on the structure, on the setup to comply.
Yeah, so in France, we have this banking monopoly, which basically restricts credit lending activities to the major seven banking institutions who have what we call a banking license, right? And they can legally, through the local regulators, the AMF and the ACPR, engage in credit activities, and it's heavily scrutinized and heavily regulated. Um, Overall, it's a great regulation, right? Because it protects both consumers and SMEs who are borrowing, and it makes sure that, legitimate and trustworthy actors are engaging in credit activities. And so overall, it's probably a good thing for the market. But the problem and the flip of the coin is that, of course, it slows down innovation. It slows down the path for new entrants like alternative credit lenders like Karmen and others to spread their wings in France, and it makes everything a bit slower. And if you compare, for example, the alternative credit volumes that are deployed by fintechs, for example, in the UK compared to France, I don't know what the differential is, but it's massive. I think we're talking at least five, maybe even 10x, just because, of course, regulation is a lot more liberal in the UK and has been a lot more friendly for these fintechs to grow and to explore.
Okay, and so I think some people will probably be surprised to hear that, but again, that is something that we see as it's a double-edged sword in that it does absolutely keep out new competitors. It gives you an advantage having gone through the time and effort to set something up that allows you to comply and lend. But it is a very unique setup. And so I'd say, from my perspective, I've definitely seen that's a big challenge in lending in France. Are there, from your perspective, are there any other challenges that you're currently dealing with from an operational standpoint, in terms of, you're thinking of, hey, this is on the horizon, or we need to figure out a better way to approach this process or task?
I think there's two things here, right? The first thing is you come from the UK with Fasanara, and you're American, of course, by origin, right? And I think, as you know, in Anglo-Saxon countries, credit is a lot more liberalized as a whole than it is in continental Europe. And when you come to continental Europe and you go to countries like France, but even more so if you go to like Germany, for example, credit is a lot more rigid. People are a lot more price sensitive. People are a lot more risk averse, just because I think the mentality and the behavior has been bred like this for generations and generations, right? So adapting a credit model with Anglo-Saxon and liberal origins into a market where, of course, the mentality is a lot more rigid and structured, of course, takes time and effort, and we have to navigate that cautiously. But overall, I think it's a great thing, because it means that the market is probably also healthier and in the interest of both lenders and borrowers. The second thing is access to data, right? And it comes back to the regulation point, is the regulation that we face as a lender in terms of banking monopoly is also faced by other players in the fintech space that facilitate lending infrastructure, right? And as you know, as an alternative lender, we rely on APIs to access data. And one of the big APIs that we rely on and infrastructures that we rely on is open banking technology. And again, the UK and the US is a couple of years forward when it comes to the democratization of access of API and open banking data. Whereas in France, there was a lot of pushback from major banks, and there's a big legacy of being a bit adverse to this kind of change, which means that the quality of open banking data that we can access as an originator is not as good as what we could access using a UK provider on UK counterparties. And I think a core example of that, for example, is that up until recently, we could only access up to 3 months of open banking transaction data, and that has now recently been increased to 6 months with favorable regulation, and hopefully it's going to soon increase to 12 months. But if you compare that to the UK and the US, it's a major difference.
That's it's mind blowing that kind of you're facing these challenges, but yet still finding ways, I think innovative ways in our view, to try to then supplement your understanding of the picture. Help with the substantiation, whether it's then by supplementing the open banking data with the accounting software data, and then forming a holistic view via the underwrite. It's definitely a challenge we see you kind of clearing, and we're glad to see that. Do you think there's going to be, you mentioned a bit of a trend that legislation was catching up, but do you think in the next 5 years, if you're looking out, do you see kind of more changes on the horizon within the regulatory framework in France, and then also within kind of borrower behavior, as maybe a new generation of SME owners and entrepreneurs is taking charge of companies?
It is 100%, and it's for sure moving in the right direction, right? I think we have a pretty pro entrepreneurial, pro business government in the current regime, and they've done a lot of reforms to facilitate both investment and development of startups, and especially fintechs. So overall, I think things are moving in the right direction. The regulators are also a lot more engaged into favorable reforms to support and assist fintechs in navigating the current environment, as opposed to maybe opposing development like it might have been years back. So overall, the paradigm is evolving. It's really moving in the right direction, and we couldn't be more excited for what's ahead. That said, there's still a gap between what's happening in the US and the UK, and I think we still have a couple of years to catch up on some aspects of both regulation and infrastructure.
Okay. We wanted to understand a little bit more on, maybe if you want to talk about a single achievement from the past couple of years that you would like to highlight to the listeners, and what you're building with Karmen.
Also, a chance to shout out any parts of your team who maybe have been pushing really hard to hit a KPI.
Yeah. I mean, look, I think I'll if I can shout out one person on the team, I'll shout out the whole team, because they've been doing a tremendous job, right? It's definitely a team effort, whether it's on the commercial side, whether it's on the data side, whether it's on the credit side. I think you guys, as our senior lenders, see more of the back end, right? The credit side, the data side, but the people on the sales side just do just as much of a tremendous job into acquiring new customers and building that trustworthy relationship that makes it so that customers come back, and once they have their first Karmen loan, they end up getting more over time. So everyone, I'm taking this opportunity to give a big shout out to the whole team. But I think the biggest achievement that we're proudest about is, growing our internal notation and criteria systems to get a more granular and to get a more deep understanding of what our portfolio and what our underlying risk looks like. And of course, when you start doing your first loans, you're trying to get originations up, you're trying to keep defaults low, like any good lender would do. But then as your book starts building up and your borrowing starts building up and you start learning from prior defaults, you start, at least in our case, getting a more thorough understanding of what your actually underlying asset looks like. How do you tranche that asset? What are the underlying risk profiles? How do you twist, your different ratios and KPIs in your model to adjust for risk profiles? And, there's so much nitty gritty work going into that by the credit team and by the tech team that we're really happy with the way it's going. And of course, there's still so much to do and so much to learn. And we have so much data that we could collect more, and so many regression and statistical analysis that we could conduct more. So the road is still very long, but they've been doing a great job, and I think we're very excited for what's ahead.
Yeah, that's great to hear. Again, a reflection of it being a team effort, it taking all elements of lending functions from the front of the funnel to the back end, the underwriting to the collection and servicing, and keeping those relationships strong. It does take a diverse skill set to build a successful lender, and we're glad to see that kind of manifested in Karmen. I think before we bring the podcast to a close, I'd ask if you had maybe one specific lesson, biggest lesson that you'd pass along to someone, or even if you said to yourself maybe 3 years ago, what would you have liked to say to yourself? What would you remind yourself, or what would you try to give as a piece of advice to someone else who might be in uni now, also thinking of launching a lending business?
That's a great question. I would say that the first and foremost thing is taking your time, right? Because it's, as you said at the beginning, right? It's very easy to lend money, right? We had, like any alternative lender, right? We get a lot more applications than capital that we can deploy, and capital that we can deploy the right level of risk, right? And of course, the hard thing is getting paid back, right? And making sure that your underlying risk profile and credit quality is high enough. And I think we've been very cautious, maybe perhaps even too cautious at sometimes, having to pass on opportunities. But, that's kind of the price to pay to have a sustainable growth. And I think everyone in the ecosystem can name companies or stories where things grew too fast and portfolios grew too quick and risk was not at the right level. And of course, over time, it just blows up in your face, and people lose their jobs and companies go bust and lenders lose their capital, equity investors, end up with nothing. And I think it's a scenario that, few people want to see. And I guess what my biggest kind of advice would be to say is just take your time, because, it's a business where feedback loops are not that quick, even though in some subcategories of lending they can be quick, like ours. But overall, it's a much longer feedback loop than other businesses. And better to grow steadily and serenely and take your time than go too fast and have the thing blow up in your face 6 months later.